Good evening, all of you all. God bless. So, dear Vaibhav Jain, I have met in SP Jain, a very outstanding student, right? And he is from the financial markets field. So, better the idea today is to give you all a very practical slant to the discussion. So, the first two sessions only I have been speaking, and I got some very good responses last time. So, all of you all did very well in the responses. So, I said the third session I will expose you all to a market participant. So Vaibhav runs a very, is the owner or is the third generation of a business which has been started and it is decades old. Decades old. He himself is an MBA. He is then did a post graduation with SPJN. Also done certified financial planner. Lot of certifications from NISM. But more importantly, better he's from the markets, so he understands what is happening in the markets. He'll understand. So today, what I've told Vaibhav is, initially when we chatted, and I just finished this conversation, I said, try and make it simple. Then I realized, why should I make it simple? Right. So I called him again. I said, you will address MBA students and you will make it tough only. You will only speak market language because it's very easy, Uddhav, for me to protect you all now here. But tomorrow when you go for interviews, all of you know jobs are tough. Some of you all will apply as jobs for with same, maybe with Vaibhav only you will apply as a job for equity research analyst, and he'll ask four questions which you will not be able to answer. So here I present to you my dear student Vaibhav, who is in the market. They have got institutional sales. They do wealth management. They are very much into wealth management. So the talk is about investments. The talk is about markets. You may not understand certain terminologies, but that is the idea. I'll pull myself back now, and I'm deeply honored that as a teacher, my student is coming over and presenting. And again, I repeat, very serious when he was a student itself, and he knows his stuff. Is all I can say. Vaibhav knows his stuff. Vaibhav, these are SIS is a college in Navi Mumbai. Students are very sincere. They want to learn, and this is a Sunday afternoon, late afternoon. Still, they are attending. They want to learn. I have finished only two sessions with them. Explained to them income drivers, value drivers. Last time I gave them an overview of DuPont analysis. Then I said, let me get the guest speaker. You know my style, beta. I always keep getting guest speakers. Thank you, beta. You are the first guest speaker, and I'm honored. Back to you, bache. God bless.
No, it's really an honor for me also, sir, because after having learned from you and being in this field, learning is a constant process. So the more you know, the more you don't know is what I keep on experiencing every day in this field, because it's never enough. So I hope I'll be able to do justice to the topic. So even though it's about valuations, I thought let me just kind of draw down on what are broadly the evolution of valuations over a long
Brilliant,
time.
brilliant,
So
absolutely brilliant.
equity valuations over a long period has evolved and continues to do so. So in the 1930s to 40s, discount to hard book was the first proposed by Benjamin Graham. uh, so back then there were these kind of modules which was discount to hard book value, so you can kind of make notes as I speak, and these are things that I would want you to search because it's not something that I can explain. In the 1950s, the way to value stocks changed to dividend yield matrix, and that's how stocks were also looked at valuing. In 1960s, it was earnings and earnings growth. In 1980s, people started looking at return on equity and cash flows, and strongly advocated by likes of Warren Buffett. And nowadays we talk of P multiples, then it changed to PEG ratio, which is price to earnings to growth multiples. So this is a matrix that keeps on evolving. Now it's all about valuations, and we know how crazy deals like in terms of private equity space happens, where say Oyo is valued at some exorbitant valuation, or whether it's Uber or different sorts of private equity companies that keeps on coming up. Valuations is the next thing that keeps on happening. Of course, there's very little significance to return on equity there, but the one framework that I would want to share with all of you in terms of assessing companies or coming at valuations in terms of different parameters is in terms of quality, And I'll tell you quality in what parameters, in terms of growth of earnings, in terms of longevity of earnings, and in terms of the price that one is buying. So when we talk of quality, we basically have two aspects to quality, which is the quality of business and the quality of management. Now, these are not things that are additive. You can't add them and get a sum and arrive at something that, okay, this looks like a good business in terms of quality, but they're more multiplicative. So quality of management अच्छा होगा, लेकिन quality of business नहीं अच्छा होगा when you multiply anything with zero. Either if either of the two components is zero, the sum is zero. So these are more multiplicative. And when we say quality of business, what do we really mean? We would mean quality, uh, in terms of large profit pools. Is the business able to generate large pools of profits? In terms of economic moat, or what competitive advantage one has in that particular business? Or whether it's in terms of ratios like return on capital employed or return on equity, which is usually higher than the cost of capital. So that will also define the cost of the quality of business for in one sense. In terms of favorable competitive structures like monopoly, there would be companies like, say, a Mahanagar Gas Limited, for example, one of the largest gas distribution companies in Bombay. It's virtually monopolistic. You cannot compete with a company which has monopoly and is the only gas distribution company in particular one geography. So these are things to look at. And in terms of positive demand supply situation, so of course, with industries moving on to gas based power plants, or every household looking at cooking gas as a resource, you virtually have one company which has monopoly. So you have to look at quality of business. The other part in terms of quality, what I said was quality of management. So here I mean in terms of competence. These are things that you would need to read about, see in terms of what the company says in their commentary while sharing their quarterly results. So you get to know what kind of sound business strategies they're. So when we talk of quality of management, the first thing would be competence. And competence we will measure in three aspects, which could be sound business strategies, excellence in execution, and rational dividend payout policy. So one case in point I can give is the comparison between both the Ambani brothers. They both, once they split back in 2006, they both came out with an IPO. Mukesh Ambani came out with a company, Reliance Petroleum, which was a greenfield project, just collecting money from public and starting off one of the largest refineries. And on the other side, we had Anil Ambani, who came out with Reliance Power Limited. Now, both issues came at the same time. Both brothers, same family. So virtually it's the name that really made people invest in both the companies. But in terms of execution, now when you look at it, Mukesh Ambani on one hand took money, got the refinery up, completed the whole project, delivered in terms of communication. Reliance Power as a company never saw daylight. So at least with Mukesh Ambani, he had a track record of execution, sound business strategy. But now, after 11 years, when we see both the brothers, it's a huge gap in terms of valuation, between both the brothers. At one point in time, Anil Ambani exceeded the valuation to even Mukesh Ambani. He was at 45 billion US dollars, and today he's virtually nowhere. I mean, all his companies have lost huge amounts of market cap. So there again, the sound business strategy is a key point I would like to give. Um, in terms of integrity, the second point in quality of management, one needs to see how honest and transparent the management is in terms of its business practice, and what kind of concern it has for stakeholders at the end of it. The third point being in quality management would be growth mindset, which is long range profit outlook and efficient capital allocation and growth by acquisition. So there are n number of examples where acquisitions have. So if we look in terms of capital allocation, on one hand we may have an example of Marico, which had the flagship brand by the name of Parachute, and somewhere down the line they also bought over Nihar from HLL, and now they're the market leaders. So you really have to look at how efficient these acquisitions are and what kind of focus companies have. So that is all these things that I've spoken about is from the quality aspect of the company. And when I say quality, I meant business, quality of business and quality of management. The second thing that you all need to look at when we talk of valuations is the growth element. Now growth would have various dimensions, growth in earnings primarily, but that also has a four matrix in terms of what determines growth in earnings. So one could be in terms of volume growth, which is a function of demand growth matched by companies capacity to supply. Can they really you know have an intake of volume growth? So here I'd like to point out one company that comes to my mind is Eicher Motors. You know, way back in 2000, it was not a great company. You know, people used to have the Royal Enfield bike, and ਉਸ time it was usually what police people used to drive, not something that was looked up with a lot of finesse as a product. But once they had a tie up with Volvo, they entered into a joint venture, and the way they revamped products like Royal Enfield and the Bullet, it really became the Harley Davidson of India. And the way they used to operate was, and this is another topic I'm just pulling out, they used to work on negative working capital, which is you're making sales on cash and you're buying on credit, so virtually your own money is not involved. And the amount of ramp up in terms of growth they saw, they put one factory after the other. They had almost a 6 month waiting time to deliver the products. So for 6 months they've taken money upfront on sales, and they have a reasonable amount of time to pay their creditors. So that really brings in a lot of efficiency in terms of the management. But here when I talk of volume growth, jo factory unhone lagaya, 6 months 8 months the production is sold. And that's a company that grew at a phenomenal 54% year on year growth. And if I remember correctly, I met the CFO way back in 2005 or something. And that time stock price was 1,000. And we felt it's kind of expensive. But, we still bought some for clients. And today we see the stock at, some 23,000 odd price. So it's seen a humongous growth. So again, in terms of volume growth is one thing which contributes to growth in earnings. In terms of price growth, which is a function of companies' pricing power, which in turns is a function of competitive landscape. The third one being operating leverage, which is a function of companies' operating cost structure, which means higher the cost, lower is the unit cost in incidence on increased volumes, and higher the operating leverage. So I'll repeat this again. Operating leverage is a function of companies' operating cost structure, which is higher the fixed cost, lower the unit cost in incidence on increased volumes. So if they produce more, the cost of unit per good will come down, and higher the operating leverage. And the fourth one being financial leverage, which is a function of capital structure. Higher the debt equity, higher the financial leverage, and vice versa. So these are things on the growth side that one may need to look at. The third one being longevity, which is longevity of quality and growth. And having established that present quality and earnings growth of a company, the next challenge to investors in assessing how long it can sustain both, quality as well as earnings growth. In that context of longevity, the competence of management is tested at two levels. One is extending the CAP, which is the cost of capital, the competitive advantage period, sorry. And the second one being delayed growth and slowdown. So extending CAP means competitive advantage period is the time during which a company generates returns on investments that exceed its cost of capital. And competition eventually drives down returns to cost of capital and sometimes even below it. However, a company with a great business and great management keeps extending its competitive advantage period, sustaining high return both for itself and its investors. So this is something that also is a key factor in terms of contributing towards the earning. And last but not the least, which is price, that is the favorable valuation. Now, growth in a stock is a multiplicative function of growth in earnings and growth in valuation. The simplest way to improve the odds of valuation growth is by ensuring favorable purchase price. That's what everyone wants. You want to buy things at a favorable price. And the price of a stock has to be seen in conjunction with value it offers. So price is what we pay and value is what we get. It's one of the famous quotes by Warren Buffett. So therefore, stock price are attractive only when they are less than their value perceived in the markets. And a simple thumb rule of favorable purchase price is a low PE, preferably single digit. It's sometimes rare to find in these kind of market conditions, especially an economy like ours where there is reasonable amount of growth. However, in certain situations, low PE may not be the sole determinant of favorable price. So if you see, a lot of commodity companies do tend to trade at single PE digits, but that doesn't mean that they're great, businesses to buy in. Personally speaking, I'm not a big fan of commodity stocks because at the end, the whole profitability of a company is determined on the price of a commodity. So no matter how good operations you may have, if tomorrow the price of the commodity, say for example steel, it goes down 30%, you may operate at full 100% capacity, but your top line effectively comes down by 30% because the price of the commodity has come down by 30%. So they may not be, it's not a real thumb rule that single digit PE stocks are always good. Sometimes markets don't tend to give great valuations to companies because they don't trust the integrity of the books. So that may be a valuation trap that you may want to avoid. And few other measures for favorable purchase price would be discount to historical valuations. When you're looking at buying stocks, see what is the decadal valuation or the average in terms of their pre PE levels or price to book value levels. What is the PEG ratio, which is the price to earnings to growth ratio? What's the discount to DCF, which is discounted cash flow or replacement cost? That today, if I'm getting a company, say a sugar mill, which is available at a certain market cap, and you can look at actually the enterprise value, which is the market cap plus the debt. If that's what I'm buying the company at, and you take out all the current assets from the company, you basically get that's the enterprise value I'm buying at. And you see, okay, if the company is generating an X amount of profit, if it continues to do so over the next couple of years, in how many years am I getting my money back? So you need, and that is something you can also look at in terms of replacement cost also, that आज एक sugar mill लगाना है, इतना outflow आएगा, but today I'm getting this company at a enterprise value of X. So that is something that you need to look at. So apart from this, certain other key parameters that I would look at while buying into a stock would be what's the kind of promoter holding one company has. What is the kind of pledged ratio to the promoter holding that is there in the company. Another thing that you should also look at is in terms of dividend yields. Is the company passing on good amounts of dividend to its shareholders or not? So certain key parameters that will also always help you look at uh, what's the integrity of uh, the management while buying a stock. So broadly, this is what I have to share on the valuation part. Again, Menon sir is there, so again he's an expert on valuations.
This entire concept of replacement cost was made popular by Mr. Harshad Mehta in India.
Mm-hmm.
So when he started this entire bull run in India, Vaibhav, you're doing very, very well. You're taking us back to history. So when somebody came in and he was known as a big bull, Harshad Bhai was known as a big bull.
Mm-hmm.
He came in and impressed everybody, and that's a very solid fundamental ground. So what he is to talk about is, suppose you want to build a factory today, what would it cost us? It will cost us 100 crores. But this company is available in the market at 30 crores. So why not buy something at 30 crores whose actual worth is 100 crores? So please note, dear students, dear colleagues, replacement cost also is a very important valuation metric. Second, just summarizing what dear Vaibhav said, the worst insult for any management is when the management resigns and next day the stock price goes up. That is the worst insult for the management. So what is the stock market saying? oh, very good, Anil Menon resigned. Now this company is going to go better and better. So that's the worst thing. So when you say quality of management, markets are always looking at what is the strategy, what is this guy going to do. The counter to this, sometimes when businesses are closed, now listen to this entire flow of presentation, huh? How a person in the market is doing it. When the business is closed, what will a DCF say? A DCF, a discounted cash flow, and we'll do that. We'll say, okay, everything is closed. But suddenly, when the business is closed, the share price shoots up. Why? Because if you see in the case of Nirlon, market analysts like Vaibhav realize that, my God, they're sitting on prime real estate. Once this business is shut down, they can sell this real estate and make good money. This is also called as liquidation value. So please look at some terms: replacement value, liquidation value. Third thing, quality of management.
Thank you very, very much, Vaibhav Bete. You took
Thank you, sir.
time
Thank you
out.
very much.
You
Privileged
really
to.
took time out from all of us. The heartfelt thanks. You could have easily said no. I've taught you 10 years back, but moment I called, you said I'll come. Okay, and I'm so happy you came and shared your knowledge. Thank you, Vaibhav Bete. God bless. God
Thank you,
bless.
sir.
Thank you very, very much.
Bye.